the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, tech giants that have dominated Wall Street for 2 years are losing their grip, with the so-called Magnificent Seven stocks shedding about $1.4 trillion in market value since December. Now, the Bloomberg Magnificent Seven index, tracking Apple, Nvidia Corp, Microsoft, Google parent Alphabet, Amazon.com, Meta Platforms, and Tesla, has fallen roughly 10% from its December peak, officially entering correction territory. But why are investors shying away from the Mag 7 then? And what sectors are now investors looking into? Well, to find out more, joining me now is Rahul Ghosh, who is the portfolio specialist in the equity division at Rowe Price. Rahul, welcome to the show.
Thanks for having me.
Thank you so much for joining us. Rahul, in 2023 and 2024, the 7 companies of Mag 7 posted enormous gains and drove the broader market higher. I mean, the Mag 7 had surged more than 160% between the start of 2023 and the end of 2024, but the index has added just 1% so far this year. Are we seeing a pivot away from the Mag 7 then? Why are investors shying away from these companies? What's changed?
Well, I think, we need to break it down to a couple of things. The Mag 7 obviously did extremely well last year, and this has been more poor. But it can really come down to the returns, the sales growth, and the earnings that they've been showing. So when you look at what's happening this year, what you're seeing in general is that the earnings estimates for the Mag 7 is not going up as much. CapEx estimates on things like AI have been going up, and the incremental returns have generally been coming down. So where these stocks had done really well last year, because, just using NVIDIA as an example, last year, the earnings estimates 1 year forward went up something like, in excess of 300%, and the stock also did well along with that. Now what we're seeing is that breakneck rate of growth is obviously slowing down, the law of large numbers, and that is really having an effect on the performance of the Mag 7. I'd also say that, year to date, there's been a big divergence between the Mag 7. Perhaps it's not always fair to lump them all in the same category. Names like Meta are still slightly up for the year. That's probably because they've shown the best ability to monetize AI within them. And then you've got the rest of the Mag 7 ranging from, being down 6-7% to down, well more than 20% in the case of Tesla. And that's really linked to, I think what's happening in politics along with the slowing in the auto cycle for them.
I see. Well, are we not seeing the same returns from investing in Mag 7 as we did before then?
Yeah, that's a great question. So the way I look at it is there's the returns you're seeing at a headline level, which is the margins, the return on equity, etc. But then also the incremental returns, which is what are the returns that they're going to earn in the future from what they're spending this year. And what we are seeing is that it's likely that the incremental returns going forward are going to be slowing down. So just an example, if you look at public data, the last couple of quarters, NVIDIA has been doing a return on equity in excess of 100%. And that's because demand for their GPUs and pricing has been amazingly strong. Going forward, it's still going to be really strong, but consensus is expecting that 100+% to slow down to something like 70 to 80%. So that's where I think we got to make the distinction between they'll still be having extremely good returns, but relative to what they've done over the last couple of years, the improvement is something that's going to be significantly less.
I see. Then what are the risks of investing in these Mag 7 stocks at the moment?
I'd say there's a couple of risks to investing in the Mag 7 stocks. But honestly, the single biggest risk that I see is bracketing the entire Mag 7 as one grouping. And, as I mentioned before, what you've seen this year is that the stocks have acted very differently. And we are finally seeing dispersion within the stocks. So within the Mag 7, I think we have to really try to differentiate between the companies that are making good use of the money that they're spending and are being able to show ways that they're turning that CapEx, into incremental revenues and profits. And that's where I mentioned the likes of Meta, what they've been doing with Instagram, ad focusing, even Google through YouTube has been able to show that. In other areas, you need to understand, a name like Tesla has exposure to a more cyclical auto industry that is affected by interest rates more than some of the other Mag 7 might be. So, I'd caution against taking all of the Mag 7 together as one basket. And I guess just second, the risk that I'd say about investing in the Mag 7 overall is given, as you mentioned, the high proportion of the market that they had become, when you do see a bit of a broadening of the market and investors deploying dollars out of, let's say, the S&P index market cap to perhaps a broader equal-weighted index into other sectors, you might find that a disproportionate share of asset flows is coming out of the Mag 7. So that is something that investors should just be aware of, albeit that is more technical rather than fundamental.
I see. Well, then, do you view the shift from Mag 7 as healthy, given that, they have become an expensive top-heavy market?
I definitely think it's healthy, but I think it's healthy rather than because of being top-heavy. It's healthy because it's a sign of earnings broadening in other sectors of the market. So if we just break down the market into, let's say, and this is talking about the S&P 500, if you broke that down into the Mag 7, the S&P 493, pretty much most of the earnings growth of the last year or so has come from the Mag 7. They, as a group, were growing their earnings in excess of 100%, whereas the rest of the market was really, flat to negative. This year, what we're really seeing is consensus estimates for the broader part of the market. We're seeing those numbers, the expected earnings growth of the rest of this year, picking up anything between mid-teens to around 20%, depending on which sector you're in. Now, the Mag 7 will still be growing their earnings, but that growth is slowing down from in excess of 100 to, let's say, 30 to 40%. So the growth gap is narrowing. The earnings growth is coming from different sectors as well, financials, industrials, materials. And that, I think, is really healthy because that is showing that there is more happening in the economy than just the Mag 7, AI, and tech.
I see. Well, speaking of AI, Magnificent Seven stocks, they rode the AI investing wave, right? Does this shift away from the Mag 7 also kind of show that AI is now not enough to drive these stocks higher, or is the AI wave overall fizzling out?
I would say that, in our estimation, it's less an indication that AI is fizzling out, but more an indication that people or investors are shifting their focus as to what they're expecting from AI. So for the last year and a half, it's been enough to say that you're investing in AI, right? And whether you saw Microsoft, OpenAI, Stargate, everyone talking about deploying more and more dollars to order GPUs and build up CapEx in order to invest in AI, that was enough to send the stocks going higher and higher. Now, I think what we're seeing is the market is differentiating and saying, well, who's actually likely to be making money from this AI? What are the products, what are the services, and the revenues going to be generated, and what are the margins that's happening on that? And in some sense, that's also passing out to the rest of the tech sector. So where the last year was really dominated by semiconductors and chips, and to some extent the larger hyperscalers, Microsoft and Amazon, what you have been seeing over the last, call it 3 to 6 months, is a resurgence of some of the software names. Because the advances that are happening in AI and the LLMs that are being announced and opened out is that finally, I think you're getting the chance for smaller companies, software companies, who didn't have the ability or don't have the ability to spending $1 billion, $2 billion, $10 billion in cash. They're getting access to advanced models, which can help them come up with software solutions that can be sold to enterprises or consumers. So in some sense, it's probably more about the democratization of AI. So AI in itself, we think, is still going to be strong. It's just that the focus is probably shifting from those who are spending money on the AI infrastructure to more about who can use that infrastructure, use the AI products in order to come up with more revenue and profit-making enterprises.
I see. Well, Rahul, now it looks like investors are also rotating into other sectors, with U.S. bank stocks attracting almost $2 billion in the week that ended earlier last month, on February 3rd. That's the second largest weekly inflow since 2008. What's driving this interest in bank stocks then?
I think there's probably a couple of things, but one is coming from the Republican administration in the U.S. Republican administrations have historically been significantly more regulation-light and deregulation-friendly. So I think there's generally that sense that we should be seeing regulation on banks coming down over the next couple of years. Now, whether that's to do with capital requirements, what you can pay out as dividends, get back to shareholders, all of that should be increasingly positive for bank stocks. I think also the second thing that's probably happening in the markets right now is with the focus on efficiency of the government and perhaps the government spend and the focus on lowering the fiscal deficit. One can think about it in terms of where the government has been spending money. That probably opens up the chance for banks to increase their loans to different sectors, whether consumers, industries, over the next couple of years, but also opens up newer avenues to grow and improve the returns. So I think it's really that aspect of, one, deregulation, opening up possibilities for banks to be more profitable, return more capital, shareholders should be doing really well. And two, as the government slowly extracts itself from many areas of debt financing, there's an opportunity for banks to take that role, which again should help to increase their profitability and returns.
I see. Then what opportunities do banking stocks offer at the moment? And do you see more potential growth in the coming months?
Well, I think, in general, the story is never one of 1 to 2 months, right? When you think of the amount of regulation that banks have had to go through, a lot of this regulation goes back to the great financial crisis. So it's not going to be unwound in just 1 to 2 months. So I think when you're thinking about deregulation coming through, that is going to be something that plays out over the next 2 to 3 years. So there's still, I think, especially for the larger commercial banks in the U.S., the money center banks, they have real opportunities because they have big businesses, they have opportunities to restructure, they have opportunities to cross-sell and improve returns significantly. I think the other area that we're also looking at is when you think of banks that are much more geared towards capital markets activity, those that have good investment banking franchises. Again, the likelihood of perhaps more financing, debt financing, equity financing, IPO markets opening up should also be pretty good for that category of financials.
I see. Well, healthcare companies, European equities, gold, and smaller tech groups have also benefited from this repositioning as well. How do you think the repositioning of investor portfolios across sectors like, healthcare, gold, and smaller tech groups reflects broader shifts in global economic conditions?
I think it probably makes more sense to take those three, healthcare, gold, and smaller tech groups, and actually break them into 2 groups. Healthcare and gold is likely a reflection of investors looking to position themselves a little more defensively, just given the current geopolitical climate, news about tariffs being uncertain and things changing on a day-to-day basis. And those are typically sectors that you see tend to be a little less GDP sensitive, hence why investors gravitating towards them. Smaller tech groups, I think, is probably more linked to what I was referring to earlier in terms of now that we're seeing the benefits of some of the AI LLMs being available to more companies at lower cost. That's giving them the ability to bring in products and solutions at a lower incremental barrier to entry. So where earlier people were worrying that smaller tech companies were essentially going to be AI losers because they couldn't spend billions of dollars CapEx, suddenly, because they have a wide array of LLMs to choose from, they actually have the ability to take part in what's happening. So I think on the side of smaller tech companies, the interest there is more of a flow-down effect, if you like, as people are realizing that AI is bigger than just the Mag 7 and what's happening in semiconductors. And that, I think, is not linked to the more defensive element of what's happening in areas like healthcare and gold.
I see. Well, then, will there be more growth in these sectors? What should investors watch out for?
Well, as you probably know, we're generally a more bottoms-up area, so we're always looking for individual opportunities in these stocks and sectors. When it comes to healthcare, we're always looking at, are there certain products that are likely to grow significantly over the next 2, 3, 4, 5 years. We, for example, been very excited about what's been happening with weight loss drugs, right? The likes of the drugs promoted by Eli Lilly, etc., because that looks to be a significant game changer in terms of massive addressable markets, very few side effects, and has the ability to perhaps reduce incidences of other disease. So I think, looking for idiosyncratic ideas like that is always very helpful, as opposed to just looking at the overall healthcare sector. The same thing goes for smaller tech groups. Always say that when you look at smaller groups, one has to balance the caution of the fact that some of these smaller names may not have the best balance sheets, may not be as well capitalized as some of the larger names, but they may also be very innovative. So what we'll be looking for is who are the companies that can address, let's say, niche markets in accounting, finance, law, who are companies that can come up with things to help you with preparing taxes, etc., where there can be a real advantage to the products that they put out. So there's definitely a lot to look for in those sectors, but I would just be wary of lumping the sector as a whole in, because you rarely get one positive factor that's good for every company that's in that space.
I see. Well, are there any other sectors you'll also be watching as investors move away from the Mag 7?
Well, besides, we've mentioned financials, I think other sectors that one can think about over the next couple of years is, to the extent in the U.S. one is still relatively comfortable about the strength of the economy, we should see more of an opportunity in more cyclical sectors, things in industrials, construction, materials, as you're seeing more and more talk about businesses bringing manufacturing back, right? Because all that fabrication, all the construction work has to be done in the U.S. But, when one is thinking internationally, you're also seeing, you mentioned earlier very briefly what's been happening in Europe. The international markets where you have a positive economic impulse, the likes of what's been announced recently in Germany. Japan's talking about it. China's talking about stimulating the consumer. I think they continue to be options as well, because even in those areas, the likes of banks, cyclicals, etc., could benefit from significant reinvestment. And I guess the final sector that is probably getting a lot of attention, you've heard about it, your listeners have heard about it, especially outside the U.S., is the defense sector. Because to the extent that the U.S. is pressing other countries to increase the percentage of their GDP that they spend on defense, that will also have a positive spillover into those economies. And you've seen that specifically, obviously, with the European defense sector. That's been an amazing place to invest in, but also in names across China, Japan, South Korea, etc.
I see. Well, overall, what factors could lead investors back to the Magnificent Seven then? And could we see renewed interest in the Mag 7 anytime soon?
Well, I think there's always interest in the Mag 7. People are always trying to figure out what's going with that. What I think people are really looking out for is, at what point does the capex stabilize and these companies start showing incremental profitability? So for last quarter, for example, I think what consensus was very focused on was the fact, if you looked at the free cash flow as a percent of sales, that number for the Mag 7 was coming down quarter over quarter over quarter because of the capex requirements of AI. And I suspect that once that free cash flow conversion stabilizes and perhaps starts improving again, that could be a catalyst for driving people back into the Mag 7. Again, for individual companies, whether it's a Microsoft or Amazon or Apple, I think people will be looking for the product or that they could roll out that take advantages. So in the case of, for example, both Apple and Tesla, they are very linked to product cycles. With Tesla, we know that there's a model changeover that's happening, so people will be looking to see what the order take-up rates are for the new models that they introduce. For Apple, everyone's going to be waiting to see what is their next generation of iPhones going to look like. How does that implement AI, on the smartphone, on the edge? What does that mean for sales and profitability? And then I think finally, for Microsoft and Amazon and Alphabet, people are going to be looking at what their cloud businesses are doing, how they're growing, what are the margins there. And last but not least, if anything, perhaps greatest, where the most focus is on NVIDIA. I think investors are really trying to understand every new generation of chips, the incremental productivity that they put out there. Is that something that we will see and be able to give NVIDIA the ability to consistently maintain their margins where they are? Again, just an example, NVIDIA's gross margins a couple of years ago were in the low to mid 40s. Today, they're in the high 70s. And investors are really trying to figure out, can they stabilize at these levels? And that really depends on the demand outlook, which is going to then depend on the rest of the Mag 7.
I see. Well, thank you so much, Rahul, for your time and your insights today.
You're welcome.
Thank you. That was Rahul Ghosh, who is a portfolio specialist in the equity division at Rowe Price. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.